Joining me here at Post 9 with the setup is Mike Mayo. He's the head of U.S. large cap bank research at Wells Fargo Securities. Good to have you. Welcome back. Where's the bag of props? You forgot at the office? Left it upstairs on the balcony? Where is it?
I can't spoil you too much, Scott. I brought the content.
Okay, all right. Well, let's get there then, because it's been a pretty decent little start here to the year for the banks, right? Citi's up 8%, Goldman 7%, and on and on. Can it continue?
Well, our base case is for bank stocks to be up 50% this year.
50%?
That's our base case.
You've been talking to Tom Lee too much? I mean, he thinks FANG's going to be up 50%. That's now the magic number for the bulls?
That's simply going back to historical valuations, and it has banks growing earnings about 14% this year, twice the pace of the S&P 500, at a time when the bank price-to-earnings ratios are at a 20% discount. So you get that re-rating back, you get that earnings growth. There's nothing fancy here. Now, if we have a hard landing, it could be down 30%, but our base case is...
That's a wide range, Mayo. I mean, for up 50 to down 30?
Well, if it's not a recession, we have up, 66%. So weighted average return of about 1/3, which isn't bad. That would be a pretty good year. And I think the one word that sums up bank earnings, what you're about to see, and for the year, is resiliency. Resiliency of the bank deposit bases, especially at the largest banks like Bank of America, U.S. Bancorp, and PNC are favorites, and that's going to lead to higher Main Street banking revenues or net interest income. Resiliency of the business models. As you have more business volume, you're going to see scalability like you haven't seen it before. So I'm a little bit above consensus on the revenues. I'm a lot more above consensus on pre-tax earnings because of profit margins. And then most importantly, resiliency of the balance sheet in the wake of slower economic growth. I think you're going to see credit costs contained. This should wind up being the best performance of banks through a recession in the modern day.
But I mean, the economy is the biggest wild card, right? So it's kind of dangerous to make such a overwhelmingly bullish call on the banks in the face of headwinds that are likely to be talked about in the morning, right? What do you think? Jamie Dimon's going to show up and say the hurricane's gone out to sea and that it's just blue skies ahead?
Well, I mean, it's hard to be a bank analyst without also forecasting the weather. So I agree, whether it's just simply storm clouds or rain or gale wind or hurricane. But that's why we do our weighted average scenarios. I will say I do think after tomorrow you're going to see, the shoe's not falling yet. It's not you're not going to see the big damage. If you see damage, it's going to be more outside of the U.S. banking industry. That's where banks have pushed off the risk. The regulators have required it. The banks have wanted it. And face it, if you're a bank CEO, as long as you don't blow up, you're likely to still have a job. And so their incentives are aligned with making sure that the de-risking leads to controlled credit costs. So even if it's a bit worse than I expect and the economy goes a little harder than I expect, we still think bank earnings grow through this recession. That's what's different. And they grow through this recession so long as loan losses do not more than triple.